Think your Indian stock portfolio is safe because of your daily sips? Think again. Since September 2024, the Nifty 50 has done something it hasn't done in years. It completely stopped making new highs. In fact, billions of dollars are quietly exiting India right under your nose. Let's address the elephant in the trading room: foreign portfolio investors, or FPIs. For over a decade, foreign money was the rocket fuel for Indian large caps. But starting in October 2024, they hit the panic button. Look at the data. In October 2024 alone, FPIs dumped a staggering 88,244 Indian rupees crore of Indian equities. Why? Because global money moves where it gets the fastest returns. The massive AI boom across global tech hubs created a massive gravitational pull. Markets like South Korea and Taiwan started surging on semiconductor demand. Meanwhile, US 10-year Treasury yields climbed back above 4.2%. When institutional money can get a guaranteed, risk-free return in dollars, why would they risk it in expensive emerging markets? They pulled the plug on Nifty heavyweights, especially private banks and IT giants like TCS and Infosys. And without their billions, the large-cap index simply lost its upward momentum. But wait, aren't Indian retail investors pumping record money into the market through SIPs? Yes, domestic flows crossed 25,000 Indian rupees crore monthly. But domestic retail money is currently fighting a losing battle against fundamental math. The second reason Nifty is stuck is a brutal reality check on corporate earnings. Leading up to September 2024, Indian stocks were trading at historically high price-to-earnings ratios. The market had already priced in flawless corporate growth. But when the Q2 corporate earnings reports rolled in, they dropped a bomb. Earnings didn't just miss, they triggered systemic downgrades. Big tech bellwethers missed their net profit projections. When valuations are sky-high, even a tiny miss causes massive profit booking. Retail investors kept buying the dips, but smart institutional money realized the growth rate no longer justified the premium price tag. Now, here is the ultimate paradox that leaves retail investors completely confused. If you look at your mid-cap or small-cap portfolio, it might actually be hitting green. In fact, the Nifty Midcap 100 index hit a fresh lifetime high. Why is there such a massive, unusual divergence between large companies and mid-sized companies? It's all about where the global economic traps are set. Nifty 50 heavyweights are deeply tied to the global macro environment, things like Middle East geopolitical tensions, crude oil price spikes, and a weakening rupee. Mid-cap businesses, on the other hand, are driven almost entirely by India's internal domestic demand. Power equipment, infrastructure, and domestic manufacturing stocks have been absolutely flying on the back of government capital spending. Because foreign institutional sellers don't heavily own these mid-cap companies, they escape the brutal selling pressure that locked down the Nifty 50. The large caps are anchored by global macro drag, while the broader market is riding a localized domestic wave. This structural freeze means the old ways of blindly buying the index are over. Wealth is shifting to very specific hidden sectors. So keep learning and keep earning.